Hey y'all, it's your boy John, and welcome to the private yacht. How did I get this? Because I actually secure my profits when selling and buying options. So today I'm going to show you how to secure your profits or limit your losses by closing your options trades. So let's get into it. And remember, none of this is financial advice. I am not a financial advisor.
Knowledge.
Later, towards the end of this video, I will be going over some live examples from my Robinhood account of options I'm going to close. Now, the question is, why do you want to close your options? Because you can either take profits or limit your losses. Now, if you're buying options, the options will expire, so you definitely want to close out of those positions to sell them. If you're selling the options, you might want to close out to secure profits early, or if the trade is moving against you, you might want to exit out of the trade for a loss. If this sounds confusing, let's go over an example on the whiteboard. So let's draw you a little happy stick face. How cute. Let's say you have a sick beard like me. Yeah, looks good. Looks kind of Amish, but that's fine. Mustache. All right. And now you have the rando on the internet. They're angry because they lost the trade, right? This is the rando. Okay, so you are the seller, and this rando is the buyer in the scenario. You're agreeing to sell a contract. This is for SPY. Okay, SP 500, and you're agreeing to buy SPY for $400. Current price of SPY is $405. This is just a random example, okay? You're agreeing to buy SPY for $400 if it drops below, and your contract price is $100, okay? So you're selling your obligation to buy SPY for $400 if it drops below, and the random buyer thinks SPY is going to drop, so he agrees. I want to buy this contract for $100, okay? So you collect 100, the random buyer loses 100. So you sold and he bought, right? So if you want to exit this trade, let's say SPY shoots up to the moon and now we're at 420. So now this put contract is basically worth nothing because the price increased, so the put goes down, right? So the current contract price now is only worth $1. So you say, hey, this is a good time to buy out of this contract, right? You sold the contract. The contract's now only worth $1. So you collected $99 in profit. So now, if you want to get out of this contract, you have to do the opposite action. You're agreeing to buy the contract back for $1 since you sold it. You sold it. It's worth less, so you got a lot of money. Now you want to buy it back, so you're buying it back. The rando buyer has this contract that's now only worth $1, so he lost $99. Sad face. Big sad. Look at that. All right? But he wants to conserve his dollar for whatever reason. So since he has this, he bought it, right? Now he needs to sell the contract to exit out. So whatever you did, you have to do the opposite to exit out of your position. If you sold, you have to buy. If you bought, you have to sell. This goes for anything. If you bought a call and you want to exit out, you have to sell the call. If you sold the call, you have to do the opposite. You need to buy the call, okay? Then if you're doing spreads, it's the same thing for both legs. So let's go over some examples from my Robinhood. You can see I have this $8.50 put on Robinhood I actually sold, and it was worth $10, and you can see I collected $9. So now I only have $1 left of market value. So why would I close out here? Personally, I'm just closing it because I want to show you guys an example. I think the chance of this dropping to $8.50 is kind of low considering the past month. But if I felt Robinhood at a strong chance, if it's like meeting resistance zone maybe, of falling back down to under $8.50, this would be a good position to exit out, right? I collected 90% of my profits. It's only worth $1. So let's try and exit out. Not going to guarantee it's going to happen because I'd probably need to put more. But you see, in Robinhood, it's very easy. Since I sold the option, I need to buy to close. I don't want to sell to open because then I'm selling another contract. I'm selling another obligation. I want to close this. So since I sold it, I'm going to buy it to close it. So I have one contract. 11. Let's try to exit out for a penny per share, right? So that's $1. So max cost is $1. Let's see if I can exit out. Now the options order didn't fill, but let me show you how to do it on the options chain if you're not doing Robinhood. So we have to select the same contract to close. So you can see my expiration was 7/7 and it was 8/50, right? That was my price. So we need to go to 7/7, which is this week. And on Robinhood, it'll actually tell you which one we had to put. You can see which one we had an options on. You can see -1. So since I sold it, I need to buy back this position. So I'm going to click on continue. And we'll see, probably won't get filled. So let's just waste $2. Let's review order. And then you can see you're paying back $2 to buy back one open contract, which will release my collateral. Submit. Let's see if we get filled. And you can see now my order was closed with $2. So I got an 80% return because I collected $10 and I spent $2 to close it back. So let's go through my Bank of America put. Again, this one I collected $22. My expiration is 7/14. I collected $18. So far, it has $4 worth left of value, but I'm going to close it out just for an example. Now, if I wanted to do it just easy Robinhood style, buy to close, because I sold this, right? So I need to buy to close it. I could just do it through this menu here. And then I type in $4, review order, then it's going to close me out, hopefully. If you have another brokerage and you actually got to go through the options chain, you have to go to the same date, right? So this was a 7/14 at $27. So let's remember that. So let's go to 7/14 for the contract. And I sold a put, right? So now I need to buy a put. And here it is. I can see -1 on the screen. So I'm going to need to buy this one back because I sold it. You're always doing the opposite action. If you bought a contract and you want to exit out, you need to sell it, right? This one, since I sold it, I need to buy it back. So I'm going to select the same expiration date, the same price, because that's the contract you own. And then we need to click on continue. I'm going to try to exit out. We'll just do $4, waste another $1, and review order. And then you're paying $4 to buy back one open contract, which will release the collateral. And submit. Let's see if this fills. And there we go. One contract purchased. So now I'm exited out since I sold it and now I bought out of that contract. So just remember, guys, to exit out of any options position, you're doing the opposite, and then it has to be the same expiration date and it has to be the same price because you traded that contract. So it needs to be the same contract you're going to exit out at. Robinhood makes it very simple with this buy to close and sell to open buttons on their website and on the app. But if you need to use the options chain, I showed you how to do that too. If you're currently trading the wheel strategy and need a spreadsheet to track your trades, check out this spreadsheet here. Peace.